Hello everyone, my name is Jan Zavala and today we're going to talk about making sense on financial ratios for your farm. This is a webinar series and this webinar is the number 10. This project has been led for Dr. Ariana Torres and Dr. Juliano Market. Okay, let's first start. What is a financial ratio? Okay, in simple words, financial ratio in farming is a calculation that helps to evaluate the financial health and performance of a farm operation. In other words, these ratios came from financial records and help farmers make informed decisions. So if you want to compute these financial ratios, you have to have record keeping for your farming. But what type of record keeping do you have to have in order to compute these ratios? For example, total revenue, sales, expenses like seeds, fertilizers, pest management costs, depreciation, etc. But what type of ratios are we looking for in this webinar? Okay, we're looking for two. Marginal benefit cost ratio, which basically indicates a benefit cost analysis and the return on investment to see if the one introduction of a new technology in your farm operations is more or less profitable. For the marginal benefit cost ratio, we know that if the ratio is greater than 1, it indicates profitability, while the return on investment, since it's a percentage, it has to be positive to denote profitability. But why marginal benefit cost ratio? Okay, this ratio basically helps farmers to assess financial viability of investment by comparing the additional benefit to the cost, guiding informed decision making. As I told you, since it's a benefit cost analysis, it compared the additional benefit to the cost. In the other hand, marginal benefit cost ratio enables farmers to optimize resource allocations and select the most profitable and efficient strategy for their operation. We also have why return on investment. Okay, basically because help farmers measure the profitability of an investment by comparing the net gain to the initial cost. Return on investment also helps farmers to assess whether a particular investment, such as new equipment or pest control methods, is worth the financial commitment. Okay, but in what type of scenarios can we use the marginal benefit cost ratio and return on investment? For example, we have the investment in a new pest control method. Let's think that we are going to compare in spinach production under high tunnel a current pest management method against aphids versus the introduction of a biological control agent. In other words, we would like to know if the biological control agents are more or less profitable than the current methods of this operation. For example, expansion of high tunnel area, introduction for new crop varieties, upgrading irrigation systems, adopting organic certifications, improved crop management practices, using climate control technology, or labor efficient improvements. Okay, but we have a formula. How can we calculate the marginal benefit cost ratio and the return on investment? Since for this case, we would like to know if the introduction of a biological control agents, also BCAs, is more or less profitable than the conventional or current methods against aphids. And then we have that the formula is the difference of the revenues and also the difference divided by the difference of the cost. Similar for the return on investment, we have that is the difference between the gross revenue minus the cost divided by the cost, and since it's a percentage, we multiply it by 100. But let's explore a real case scenario to see how can we run or compute these ratios. So we have a small farm from the peri-urban in central Indiana. A little bit of the area is 1.5 acres, and the spinach was planted in a little bit above of 1,000 square feet. They sold in direct-to-consumer channels like restaurants, farmers market, in a price per pound of $10 in spinach, and also the yield for that spinach cycle was 440 pounds. The total cost was $1,100 without introduction, in other words, their conventional methods, and the gross revenue was $4,400. The total cost with the introduction of biological control agents, of course, it has to be greater because you are introducing a new technology, is 100, 500, $1,500, and also the gross revenue is, if we can see, is a little bit higher because for this case, this beneficial insects improve the marketability, so it was a little bit fewer than $5,000. So we have some results in, for example, in the marginal benefit cost ratio, we have a 2.08 ratio. So what is this ratio means? Basically, for every $1 that you invest in biological control agent, in this case lacewings, instead of your current aphid control, the farmer gains an additional $2.08 in gross revenue. We also have the return on investment of $250 that we basically said that for every $1 that this farm invested in lacewings, the farmer gains 2.50 cents in net profit. With that being said, we have some conclusions that the financial ratios like marginal benefit cost ratio or return on investment help farmers to make informed decisions by clearly showing whether a new investment like lacewings for aphid control adds economic value for the current operation. In addition, these ratios demonstrate that the lacewings is not only effective biologically but also financial sound because we have been proved with this information that the farmer that the farming in this case can gain a little bit more of money. And in addition, using these financial indicators allows farmers to compare pest management strategies based on profitability, supporting better long-term planning and resource use. With that, I would like to thank everyone. We have a QR code that we have a small survey that could you please scan the QR code and solve this question so we can improve our next webinars. Thank you so much, and I hope to see you in the next webinars.